Welcome to the Get Rare show. The whole idea of this show is to bring experts in the industry and property investing to help you out with all sorts of questions that you might have. Today we are having a chat with nobody else but Munzurul Khan, chartered accountant and principal of Kershaw Chartered Accountancy. Lots of people know him already, but in case if you don't know, maybe I'll ask you if that's okay to introduce yourself.
Thank you very much. Thank you for inviting. Munzurul is my name and I'm the principal of Kershaw Chartered Accountant. We've been running this practice for the last about 12 years or so. The background is a couple of a small practice, and then I worked in BDO for about 6.5 years and PwC for about 4.5 years. So I started this practice all the way back in 2008, 2009, and it has been a journey since then.
I can really appreciate that. We are actually very good family friends. I have known Munzurul for quite a long tenure, so I really appreciate all the guidance that I've received from you, Munzurul. You are a voice in the property investing that I've always seen, and I really appreciate and thank you so much for coming over.
Thank you very much.
And joining us today for the benefit of the audience as well. Wow, so 2008-09, you have started your practice, so about 12 years, 13 years. And what do you think of the property cycle, where we are, what we used to talk about post GFC then and now? So any comments on the property cycle, where we are?
Yeah, probably is the most pertinent question that we've been hearing nowadays, right? So this is March 2021. Now, I suppose the very first comment which I say in terms of the cycles is that very often there is no one cycle. It depends on which estate that we're referring to. To some extent, it also depends on which type of properties that we're referring to. Are we speaking about residential, commercial, industrial, infrastructural sort of an asset? But if we look through the residential property side of it, is that we can see the buzz in the open world, right? Last weekend, as an example, the auction clearance rate in New South Wales was over 90%, and I think it was 90% in the consecutive last 3 weekend. I look into Melbourne as an example, where the listing was a lot higher, and Melbourne was in early to mid 80s. I look into Brisbane, which was mid 80s. I look into Adelaide as an example, which is about 89, and the list goes on. So all of those, it shows that the property is at a level where there is quite a bit of interest in the property at the moment. Yes. And the market is definitely an upswinging market and is definitely increasing. We look back and we say, why is it? There's a whole lot of things, right? We start with the interest rate being rather low. I've been investing for about 21 years, and probably most people have never seen of the interest rate being in twos. So that's mid twos and late twos, and P&I is not so uncommon, even less than 2. So interest rate is rather low. The responsible lending and the government is putting in all this cash injection. Even the unemployment rate is not that bad. It's early 6, and we've got a light at the end of the tunnel, and the solution behind it. All of those, your pure hardcore reason, as well as the general market perception, they're all combining into an increase in the property market. So cycle, in my view, is very strong. The bigger question that I asked to myself is that how long is that cycle?
That was my follow-up question, actually.
And how long? And this is where it becomes a bit tricky, because we are questioning about the timing of the market. When is the property market is going in its reach? No one knows, but there is a general view that it is another year to year and a half, maybe about a couple of years, that the prices increases quite a bit. So my overwhelming comment would be is that yes, the market is very strong at the moment. When is the market reaching its peak? One needs to look through the fundamental behind it. What's the return that we're receiving? And if the return starts to become rather low, the prices start to become rather high.
Of course. Now, that's a very good answer, very comprehensive, talking about the whole cycle. But I also see that, yes, this is March 21. But if you take the time back to March 2020, that was the onset of COVID, and there was a scare where the global economy is going, and luckily the Australian government has done whatever it could do with regards to the stimulus. But then also I see that what we were seeing in the media, what they were talking about, the property crash and whatnot, and a bit of scare. And how do we justify it? Like when we are talking about fundamentals of the property market, and within a span of 10-12 months, it has taken a entirely total flip in the media.
You're 100%. It's actually a very good comment. There's a couple of elements with the market. The pure fundamental of the market, which is the raw data, whether the market sort of makes sense, the science behind it. and the signs that we would walk through. But there is a second element of the market which is more about the emotion,
Yes.
more about the fear, even the greed as well, the fear of missing out and all the sort of things that comes in. And unfortunately what it does is that bit of the emotion seems to be very often we overreact to that emotion without looking through the fundamental to a great extent. So if we look back with the GFC side of it, extraordinary event. Of course, none of us, we've seen it, none of us, we knew what was the sunset clause, so to speak.
Yeah.
That means when would that virus will end in March, we did not know, whether it's a 1 year, whether it's 5-7 years or longer period as such. So there was quite a bit of uncertainty, and I think what the market did is that the market has, if anything, over-compromised for that uncertainty at that point of time. But if we look through in terms of the science behind it, this is 2021, and back in 2019, when we were at the end of 2019, the auction clearance rate was very high. It was early 80s and mid 80s. And we all geared up for 2020 to be a very strong year. And the month of January and month of February of 2020 was very strong year. And then the virus sort of came in. And the reason why it is a strong year is that we look through some of the fundamentals. I used to always work as a rule of thumb of 5% return. So I always used to say that, well, for a $500,000 purchase, if the rent is about $500 per week, that gives you about 5.2%.
Sure.
As a gross return. That sort of more or less covers the interest. Perhaps that's stabilized market. Now, because the interest rate is so low at the moment, more importantly is that the banks are suggesting that the interest rate are going to stay this low much longer. And the only way we can see that is that if we look into the 3 years fixed, we look into the 5 years fixed, they're very low, right? 3 years fixed rate of mid twos and late twos is most common, right?
Actually, I've seen some numbers below 2% as well.
Yeah.
Like Westpac announcing recently fixed term rate of 1.89 or something. That's crazy.
Yeah. So see, with that, what that basically means is that the banks are saying that that's the interest rate that we're saying over the next 2 to 3 years. That means the bank's perspective and the view is that there is not a lot of increase of the interest rate, at least in the short to medium period of time.
Yeah.
That's the bank's view, right? So when the funding is so much lower, I think that entire paradigm, what we spoke of that 5% return, that by itself is changing, in my view.
Yeah.
Because very often the commentator nowadays says that rule of thumb of 5%, perhaps it's more about 4% is the new norm. Because we've never seen this sort of early twos and sort of mid twos and low
Yep.
twos as such. And if we say that is that those twos are almost normal for 3 or 5 years and 4% gross is almost normal, it means that market has got a bit more space to go. I've got a number of my clients in the last 2 or 3 weeks is that they've bought properties around that sort of easily 4% plus.
Yes.
That means within that definition, arguably, market is maybe still not too pricey.
Now, that certainly is a good point. And also, I would also add from what I'm seeing is that for a tenant who's paying the rent, and now they're looking at like rent on the same numbers, they're paying about 5% for the property, and they can go to the bank, knock at the doors, get maybe low twos, high twos. They're still far better paying the mortgage rather than the rent.
And 100% agree. And you got to we also take into account that the government is constantly injecting all of those funds.
Yes.
There's the statistics that I was reading that the Australian household plus the SMEs in March 2021, on combination, they would have about $220 billion of extra savings.
Wow.
Together as the Australian family, so to speak, compared to what we had in March 2020. The question comes in, the first question which I asked myself is that where is all the savings coming from? I thought we were in virus, right? Where are all the savings coming from?
There was no movie theater, it was Netflix. It was not going out and having food, it was having food at home kind of thing.
You 100%, there's two sides, right? Absolutely 100%. One side is that, well, the government borrowing has increased.
Yes.
So the government has injected a lot more cash, right? Whether it is in terms of the bond or whether it is any other level of monetary contribution from the government side of it. So government's loan has increased, and our benefit is that when we started with the GFC, our balance sheet was so strong that we really didn't have a lot of outstanding as a country as such balance sheet. So government could borrow a bit. Government borrowed, government injected that fund back into the economy. That's number one. And the number two, exactly what you said. What do we do with all of those funds,
Yes.
right? We can't go overseas, we can't go dine and wine, we can't travel around. So what do? We save them.
Sure.
And all of those has an impact in the property market.
Certainly. I'm actually hearing two things from you right now, Munzurul, if you don't mind me summarizing. I actually heard it. Is a property market is booming in general,
Yeah.
but then I'm also hearing that there are multiple markets within the market. So really it comes down to two main aspects of it. One is the risk appetite of the individual,
Good point.
and B, having the strategy around it, like how they go about navigating it. If every neighbor is doing it, doesn't really mean that it makes sense for us as an individual to do it. So give me some comments around it, like how or what the person should be thinking, because I guess everyone is listening out there that interest rates are low. There's a lot of advertising, lots of marketing, and someone who's by himself paying rent and now he's thinking that should I really go about getting the market, the scare element as well.
Yeah, life to me quite a bit as a balance. And what the balance means is that, of course, we as sort of the investors is that we need to be rather vigilant. We need to be in the open world. We need to know all the information with the open world, but not to also get too sewed away with the open world where I become a bit of a herd mentality and saying that yes, everyone is buying it, I'm buying it, that's what I'm being hearing. Someone bought it last month for 500,000, now it's about 530, right? All of those things that is that we don't get sort of swept away with this. I think the fundamental of it, which is exactly what you said, is that we all need to have our own goals.
Yes.
What is my SMART goals? Specific, measurable, achievable, realistic, timely. What do I wish to achieve? And reiterating to myself is that property investment is a long-term game.
Yes,
so what that means is that yes, there is quite a bit of an upswing at the moment. Is that what I've seen with the multiple cycle in the past is that market always has a habit of somehow overshooting itself, becomes overpriced, and believe it or not, then the prices drop.
Yeah.
And I've seen the prices dropping anywhere between 10, 12, 15% for a period of time. I've also seen that for about 6 or 7 years, prices stay stagnated and it doesn't do anything. But in the years when it does increase, it may increase rather strongly, anywhere between say 15, 20% or so. So I think it's very important that yes, we read everything, we listen to everything and we speak to everyone, but at the same time we stay very true to our own personal goals. The goals may slightly change,
Yeah.
but not to deviate too much from the goals.
I really appreciate that. And my question to you as a follow-up of that is that, yes, one should be looking inward and thinking personally about the strategy and the
Yeah.
goals. But then if I don't know anything,
Sure.
I won't even know even what to do with that. So as a guidance, what should be thinking as an individual who's trying to get in the property market? All I'm hearing as an individual that there are so many people trying to do something, and should I just jump into the herd behavior? How do I go about navigating through that for the noise or the information or the media? Goal is very conceptual thing, like where do we get that information from or the guidance from?
Absolutely. And that's where the professionalism and the professionals sort of come in. And that's where the specialized group of people come in. So let's say from ourselves, you are buyers agents and you've been doing it on a day in, day out basis. I'm investing for last about 21 years, but I would still not know the market on their nitty gritty as you do. The reason behind it is that this is what you're doing it as a full time. You're making all of those phone calls on a daily basis. You're speaking with the agents. You're speaking with everyone. So some of the deals that you may receive, they may or may not have even come in onto the market.
Yep.
How would I know some of those deals? This is coming in from someone who's an experience. Now let's take it back and say that someone who's coming in as a more of a junior person. You're right, there's just so much information in the open world and that creates a confusion. That creates an ambiguity. And the best answer that I can say is to sit down with someone professional, someone who is number one, who's gone through the journey,
Yeah.
someone who is currently being on the journey, and someone who does it on a professional basis. So sitting down, really mapping out the goals and objectives and the plans, and to run through the numbers. Yeah.
Sure. Thank you for that answer. For example, like somebody's trying to build the portfolio or think about buying a property. There's so many questions out there, like what sort of deposit we need to have, what sort of structure,
Yes.
whether they should be buying their personal names. Would you mind running down some sort of things to consider or what options do they have?
Good question. Very good question. And there's different element of that question, right? So what sort of a structure that we sort of buy it, what sort of deposit that we do it, whose name that we buy, all of those are valid questions and a lot more. And all of those needs to be looked into, right?
Yeah.
And each has got a very long answer to each one of them. But if we look through a structure as an example, the common question that I hear all the time, do I buy it on his name? Do I buy it on her name? Do I buy it on a trust? Do I buy it on a company? Do I buy it on a joint venture? Do I buy it on a superannuation fund? So each structure has its own merit and each structure has a time and place for it. To give you an example, one or two examples, right? Let's just say husband and wife, and let's say that husband is earning about 100,000, and let's say the wife is earning about 250,000, right? And let's say you're buying a particular property which has got quite a bit of negative gearing component to it. Let's just assume,
Sure.
right? On that example, it's a logical sense to say, perhaps if we buy it on wife's name, because she's at a lot higher level of the income, we get a lot more tax benefit as such. However, the objective of this particular property could be is that yes, he bought it with that sort of negative gearing, but the whole area is going through the rezoning, and we would be selling that property in next 2 years. And by selling it in next 2 years, because it's going to go through the rezoning, the prices will increase by, let's say, 2-3 times as such.
Sure.
So while I'm getting the negative gearing benefit for 2 or 3 years with the higher level of the income, when I do sell it, the wife being at the highest level of the income pays a lot more tax.
Of course.
And the whole thing, unfortunately, becomes a bit of a fallacy. Because he saved a bit of a tax for 2 years, but he paid the significant amount of tax. On that example, it would have been better off to even give away that bit of the negative gearing in the first couple of years on husband's name, on that example, knowing that all this capital gains coming through. So I suppose the comment comes in is that one needs to strategize it. One
Yes.
needs to really sit down. I'm a big fan of those SMART goals where we sit down and say, Father, that this is what my financial circumstances, this is my assets, liabilities, and these are my income and expenses. And then I explore saying that, okay, all right, Father, where is my goals and objective? And as long as I know that's my goals and objective, then each property, in my mind, is that one must buy with an exit plan, almost with a semi-business plan as such. So that example that I've given is that why am I buying this property? If on that example, husband and wife, they're purchasing this property to hold it for many years, maybe buying it on wife's name was the right decision.
Sure.
But if they were purchasing, saying that after a couple of years is that we're selling it, receiving all of those capital gain, perhaps buying it on the husband's name was the right
Sure.
thing. So each needs to be looked into on its own.
So what I'm hearing from you is that it really depends on the strategy and the objective,
That's right.
along with the circumstances.
That's right.
And tying it back with your response to the previous question,
That's right.
you really need to take a professional advice who has been looking at this on a daily basis to be able to make the right decision.
Absolutely. Each individual, they've got their own risk
course.
profile, right?
Yeah.
Each individual is a different age bracket.
Yes.
Each individual might bring in a different level of capital contribution to start with. Each individual may have a different plans in their own life. So one is to take all of those things into account to say what is the right strategy.
Sure. I actually come across this dilemma of people really thinking about when they're selecting a property and trying to strategize on their own, that should they really be thinking about negative gearing or positive gearing, or in other words, should they really go after capital growth or cash flow? And what surprises me that they actually stop over there. Because just if you're thinking about investment in general, there are typically two aspects of it, like risk and returns. However, in property investing, we are only focused on the components of return, as in cash flow and the capital growth. But not many people talk about risk. And
Yes.
what is your take on that?
Very good question. As we both know from the financial background that the return is directly associated with the risk that we take. So in an ideal world, what we would like to do is that we'd like to have the capital growth, would like to have the cash flow, and would like to have no risk. Wouldn't that be lovely? The ideal world would love
Can show me, but
I would love to, right? But the reality of it is that it almost doesn't exist.
Yeah.
So what that means is that what is the right combination of all of the above?
Yes.
What's important to me on that basis is my priority on the basis of the risk profile that where we are. So let's have a look through the risk profile. What's the definition of the risk profile? Now, I've got an investor who says 80% is rather high. They would only borrow 2/3, so 65 to 70% is the maximum. That's their risk profile. That's nothing right or wrong. I've got investors who would not be borrowing anything less than 90%,
Yeah.
because their argument on that 90% is to say that, come on guys, with that lower level of the interest rate, with that extra leverage that I receive, I get that compounding impact. And when you multiply that compounding impact over a longer period of time, my return would be significantly higher than this other gentleman, as an example, who's taken only about 2/3 leverage as such. Now, there's no question to it, is that he has taken the higher level of the risk. But the risk to me, Vaibhav, is very often is that how do we manage it?
Sure.
And managing of risk to me very often is the information behind it, is to break down the risk. What does that mean? So on that example, let's just say that someone who's sort of borrowing, that's a 90% as such. The fundamental math that I would be doing it is that how much does it cost me to hold it? So it's not so much the 80%, it's not so much the 90% or any other percentage as such, right? How much is it costing me in terms of holding it on a week in, week out basis? Now, then to be conservative, what I will do is that I will even add away extra couple of percent interest and say, if the interest rate goes up to 2%, can I still manage it to some extent?
So that's basically building some buffer.
Exactly.
All right.
Even put in an additional buffer. Also, you know what? Property prices may not be renting for 52 weeks. It may be, let's say, 48 weeks as such.
There might be vacancies out there.
That's right. Can I still manage it? So as long as I break down that information into that different analytic, is to say that yes, the interest rate goes up, can I still manage it? Yes, if your rent goes down a bit, still manage it. That happens, can I still manage it? Now, once I do this, then that to me, the risk is being mitigated. And then as a basic rule of thumb, what we always say to many of our business clients and the property investors is that ideally, if we keep about 3 months worth of expenses as a buffer, you've got that fallback provision.
And that is the minimum.
And the last comment, if I may say in here, is that what I found over the years is that from my experience is that of course we all go for the cash flow. Cash is the king, and we say that, right? You don't want to build a house of cards and the cards follows through, right? So we want to build a real good structured bit of the portfolio, but in the longer period of time, simply because how the maths work, it's the compounding impact, and the compounding impact, i.e. the growth, that gives you the more level of wealth, as long as the cash flow can be managed.
Thank you so much. And just switching gears and talking about building a portfolio.
Yeah.
So for example, like if there's one who has a borrowing capacity of about a couple of $1 million and he's all good, of course he has taken help of professionals doing day in, day out. And now the question that he has is like, should he really go and buy one property of $2 million or really think of diversifying the risk by buying maybe 2 or maybe 3 or even 4 properties with that budget? What is your take as an overall risk strategy on that?
You know what? There is no one answer, right? There is no one answer because on the basis of that individual, his our own risk profile, goals and objective, one property could be the right decision.
Sure.
Or multiple property could also be the right decision on the basis of that particular individual. Naturally, rather than having all of your eggs in one basket, so to speak, if the eggs are being spread in 3 baskets, perhaps whether we have diversification. It may not be even in one estate. You may have in multiple estates.
Sure.
So if one estate is not doing very well, another estate is doing very well, then you balance it out. So one may argue that yes, you've got some level of diversification and your risk is being rather managed. You may have 3 lots of tenants as an example with those 3 different properties, and having 3 properties, 3 tenants, the likelihood of all 3 tenants of not being in vacancy is lower compared to 1 tenant as such. So there is an argument to say that perhaps it's a diversification gives you a little bit more strength. One may also say that each transaction that while we consider with an exit plan, that how do we sell it? In terms of the number of people, the open market who we can sell it, is that someone around that sort of a first-time buyers is that you've got a lot more people. As opposed to it going into say 2 million or 3 million, your risk sort of gets a little bit more limited. So one may argue this. But on the other side, I also use a counter argument that sometimes things we say they're cheap because there is a reason why they're cheap.
Sure.
So if it is too low a property, that by itself attracts a certain caliber of tenant and the location which may or may not be the right for you. I remember the old book that I read many years ago from Jan Summers, right? Jan Summers from More Wealth, many years ago that I still remember. And Jan says that if we say between 1 to 10, and 1 being you're absolutely middle of nowhere, it's an absolute old shack, and 10 being right in the waterfront, the best of the location, the loveliest of the property, Jan says what type of property that I would like to buy. And in Jan's definition, Jan says that I would always like to buy in between say 3 and 4.
Okay.
So I don't need to buy that 8 and 9 or 10, which is good capital growth wise. But what it does is that it doesn't give you enough cash flow. But if we buy 1 and 2, then it becomes so low, so sort of a lower end that by itself has a risk. And how do we balance it? And if I look back into my investment journey, I tend to have done years after years, and that in my mind is a measured, balanced approach.
Sure. I really like the book article that you talked about. Is that yes, we talked about the risk of getting into the once type of the properties as in like middle of nowhere. Yes, like when we talk about going regional, people all of a sudden start thinking that oh, it's 1 versus 10 as in like regional versus this. But yes, as you said, there's a spectrum of the properties. There are CBDs within those regional areas as well, or even going outskirts of the metro city is also
Good point.
probably an answer. And this is great. No, thank you so much. And I really believe that, well, like personally, I learned a lot from this session today, Munzurul. I really appreciate that. You mentioned that you have been buying properties for quite a while now. So would you mind sharing maybe some sort of example or things that you really enjoyed through your journey?
Thank you very much. I have always been a big believer of consistency and persistency. I have always been a big believer of not so much the rabbit, the sort of the turtle, who sort of goes slow and steady and slow and steady, but he always goes. He or she always moves,
But
always
that's a
moves.
long-term thing. Come on, we don't have patience.
That's the kids, that's the modern generation. And yes, a long time, right? So I look back with many of my properties, and because I've been investing that long, I look into many of my properties and I see some of the properties that I bought at a point of time, let's say 15 years ago, 18 years ago, 10 years ago. You know what? It was a very basic mom and dad property. So there was nothing extraordinary. It's not that I've received a really extraordinary price. It's not that I had that enormous master plan. I knew the inside information, none of the above. But what worked in my case was the action, and that is what it worked in my case. It's not so much as an armchair investor. It's about I dreamed, I believed on my dream, and then I went through with the action. And the benefit of doing this, of having the dream, believe, and you taking the action as such, is that I look back after that 10 years, 15 years, and many of those properties, they've actually been rezoned. So to give you an example, I bought this property which is in 𝐬𝐈, and that property was bought, it was 𝐬𝐈 property, but that is all I could do at that stage. It was a 𝐬𝐈 property, and it was about 900 odd square meter land. Now, after holding this for that many years, council is now allowing that 900 odd square meter land is that I can subdivide, which is currently with DA, and
Nice.
we're almost at the end of the DA. So I can subdivide into two properties, and I can build house with a granny flat, house with a granny flat. One letting becomes four letting. Now the benefit in here is that my land cost is still the same because I bought it a number of years ago with the land price.
Yes.
And I'm having the new construction price as today's construction price, but my sellable value is the new construction price plus today's land value.
Yes.
Even though I bought it in yesterday's land value, and that's where the capital growth and the potential coming in, plus the full level of income gives us the cash flow. So that is an example that where it really worked out very well, because not only I relied on the natural growth, I was fortunate on that example that it also gave me the manufacturing growth. I want to say that each purchase that I buy, I look into it and I say that, okay, I'll rely on the natural growth, but are there opportunities that I can do it over a period of time? Do I have an option to subdivide? Do I have an option to build a granny flat? I may not be financially in a position or emotionally in a position where I actually take the time and the effort to subdivide it.
Sure.
But the fact that I have an option to it, that by itself has a sellable value.
So I guess like you're talking about slow and steadiness, and I guess you're a testimony of what you just talked about, having the smart goals, having the vision and the dream and then action part of it.
Yeah.
And then when you're talking about reviewing your properties, what you can develop, what you can subdivide, it seems that you have gone with the approach of multiple properties, and as and when you could do something, as you said that you couldn't really do much beyond what you could do in 𝐬𝐈 at that stage, tells me that you were always up there in terms of finding opportunity, what you can afford, as much as it fixes in your strategy. That's how you have been following through. Is that right?
That's right. Because see, I actually genuinely look back further in my life, and I had some wins and some was nothing extraordinary. But I think it's the action, it's the action, it's the action.
Yes.
And very often one says that any action is arguably better than no action. To give you a simple example, many years ago, back in 2000, I remember that 1999, I bought my very first property in an area called Ingleburn. So I had this very good friend of mine, and we were both looking into properties at that point of time, and I bought a 3-bedroom house in Ingleburn, nothing fancy, for about 120,000 at that stage, and that was the market value, not high, not lower. Now the other gentleman, he wanted to buy something really nice for his renting side of it. Again, nothing wrong. He ended up buying a property at that stage back in 1999 for about 189,000 of 2-bedroom townhouse, but it was a brand new townhouse. And in my case, it was a house with a bit of a land, but it was more sort of a standard sort of a house. Now, once he bought it, we went back and we did a bit of a valuation of it from the bank side of it. Bank actually came in saying that it was overvalued. So what he paid was significantly higher. Bank valued it in that day was about 155,000 or so. And I remember that gentleman was taken back, and that was my first decision. And I bought it at that sort of a higher price, and I've lost it. whether he did, let's just assume that gentleman still did hold on to that property. Let's assume that yes, he did pay such significant higher price in day one. The value of that property in today's market is about 650 or so. So even on a wrong decision that arguably he did, the fact that with the assumption that he held on to it that many years, that he would have still done okay. Perhaps not as well as some of the other example, but he would have still done okay. And the rationale behind it and the knowledge behind it is the action taking. If he were not to do any action, whether he's lost a bit or not in the first place, he would have never had that opportunity again.
That's an interesting example because it's in hindsight, we can look back and see what could have been done or what has happened. But at the same time, if we take the decisions a bit more, I guess, strategically and thinking about patiently, that makes really sense. Munzurul, it has been a great session. Now, thank you so much. If I have to ask you for the sake of audience out there, like where they can find you, because you are full of energy, full of knowledge, full of experiences. I'm pretty sure a lot of people would like to connect with you directly. So
thank you very much. Munzurul is my name. Our website is 𝐭𝐻𝐜𝐵.com.au and 02 9633 5511. Thank you very much.
Thank you so much. Really appreciate that.